We've all heard Warren Buffett's advice: be fearful when others are greedy and greedy when others are fearful. But how do we apply this in today's market? After all, it's hard to know what everyone else is doing. Are stocks overvalued? Should you sell? What's a safe place to park your money? Well, at Berkshire Hathaway's most recent shareholder meeting, Buffett himself made some moves that might just offer clues about his outlook for the markets. And it's not what you think. The Oracle of Omaha bought a bunch of monkey business. What does this mean? Let's take a closer look. Welcome to our channel, the place where future billionaires come to get inspired. We cover everything business, investing, and entrepreneurship so you can start your journey towards financial freedom. So let's dive in. In this video, we'll be discussing two particular purchases made by Berkshire Hathaway during the first quarter of 2023. They are Celanese Corporation and the chemical and mining company, aka ChemChina. Now, before we go into the details, remember, these are just observations and guesses. No one can truly know what's going on in the mind of Warren Buffett or any other investor. So, what exactly did Buffett buy? Well, firstly, Celanese Corporation. This company is a chemical manufacturer founded in 1902 and based in Texas. It has a diverse range of products, including engineered materials, cellulose acetate, and specialty chemicals used in industries from aerospace to automotive, from consumer goods to electronics. Now, why did Berkshire Hathaway purchase a $148 million stake in this company? Well, there could be several reasons. First of all, the company has a solid history. For instance, since 2017, it has demonstrated impressive revenue growth, averaging around 16% per year. In the last 5 years, the stock has shown an increase of almost 160%, outperforming the S&P 500. Moreover, Celanese has a strong balance sheet with almost $1 billion in cash, low debt, and generates significant free cash flow. This means that the company has the financial stability and flexibility to navigate through economic challenges and invest in growth opportunities. Finally, Celanese has a competitive advantage in the form of its global leadership position in key markets and its focus on research and development. These factors have enabled them to produce high-quality products that meet the evolving needs of their customers. The second company is ChemChina, a huge Chinese corporation that produces chemicals and mining products. Why would Buffett suddenly turn to China? Well, ChemChina offers several attractive features. For example, the company has been growing both organically and through acquisitions, expanding its product offerings and global reach. Moreover, ChemChina has a dominant market position in many of its key segments, giving it pricing power and the ability to generate consistent cash flows. Lastly, ChemChina trades at a relatively low valuation compared to its peers. Even after its recent share price surge, which saw a remarkable increase of 350% since 2019, the company still appears undervalued based on various financial metrics. This suggests that Berkshire Hathaway may have found a hidden gem in the form of ChemChina, a company with strong fundamentals trading at a discount. But the big question here is, why did Buffett make these purchases now? Is he anticipating a recession? Perhaps. Remember, when others are fearful, Buffett becomes greedy. Right now, there's a lot of fear in the air. The global economy is projected to slow down significantly, with many countries teetering on the edge of a recession. This is fueled by rising interest rates, ongoing geopolitical tensions, and lingering effects of the COVID-19 pandemic. As a result, investors have been selling up and retreating to safer investments. But Buffett isn't fazed. He's seeing opportunities where others are seeing only risks. He's been quoted as saying, "Be fearful when others are greedy and greedy when others are fearful." In other words, when everyone's losing their mind and selling off their investments, he's buying in. That's exactly what he did during the 2008 financial crisis and again during the pandemic. and it looks like he's doing it once more. Moreover, it is also possible that Buffett believes that these companies have long-term growth potential despite the short-term economic challenges. He's known for making investments that stand the test of time. He doesn't panic sell when the markets crash or buy into speculative bubbles. Instead, he focuses on companies with strong fundamentals and competitive advantages that can weather economic storms and continue growing over the long term. However, let's talk about why these purchases might not be what they seem. Some argue that Buffett's move is actually a way to boost Berkshire's bottom line in the short term rather than a bet on the long-term prospects of these businesses. Here's why. Firstly, the sale of Apple stock. You see, Buffett's been trimming his stake in Apple, a move that has raised eyebrows given Apple's status as a blue-chip tech giant. However, it turns out this decision was driven by a simple, too much exposure. At its peak, Apple made up nearly 50% of the entire portfolio, which goes against Buffett's usual diversification strategy. So, it was time to balance things out. By shedding some of his Apple holdings, Buffett is ensuring that his portfolio is less susceptible to any single stock's performance. This move is particularly astute in light of Apple's recent market behavior. Despite being a market leader, Apple stock has faced headwinds to concerns over slowing demand for consumer electronics and its high valuation. Secondly, the insurance float. Insurance float refers to the amount of money an insurance company collects from policyholders but doesn't immediately need to pay out on claims. This is essentially a giant pool of funds that can be invested to generate profits. Now, while it's normal for insurance companies to invest these funds, Buffett has taken it to an art form. His float has grown exponentially, becoming a significant part of Berkshire's overall investment strategy. In fact, insurance float has contributed significantly to the growth of Berkshire Hathaway since its inception. Over the years, Buffett has built a robust insurance business, including well-known brands like Geico and General Re. These insurance operations generate substantial cash flows that fuel Berkshire's expansion into other sectors. By investing the float wisely, Buffett has been able to grow Berkshire Hathaway's book value per share at an impressive rate, delivering value to shareholders. And lastly, the stock buybacks. Berkshire Hathaway has been repurchasing its own shares in recent times, signaling confidence in its future prospects. Buffett sees the current share price as undervalued, believing that the market is inaccurately pricing in the company's true worth. By buying back shares, Berkshire Hathaway is increasing the value of the remaining shares and improving its financial position. This move demonstrates that the company doesn't have better investment opportunities elsewhere and that it believes its current projects are the best use of available capital. So what does it all mean? Well, we can't say for sure what's going on in Buffett's head. But these moves do paint an interesting picture. They suggest that he is always evaluating his portfolio and making adjustments based on his assessment of risk and potential returns. He is not clinging to his previous investments just because he made them before, and he is willing to adapt his strategy based on changing market conditions. And remember, whether it's the stock market, real estate, or any other investment, timing is crucial. When others are feeling confident and the market's on the rise, it's easy to feel like you're missing out when you choose to wait. But that's often when the best opportunities arise. Timing is everything. In conclusion, Warren Buffett's recent moves, although seemingly perplexing, reveal his timeless investment wisdom. He's adjusting his portfolio based on market conditions and company performance. Whether it's trimming his Apple stake, utilizing insurance float, or buying back shares, each move is a calculated decision aimed at maximizing value for Berkshire Hathaway and its shareholders. As always, Buffett's strategy is a blend of careful analysis, patience, and a willingness to adapt, making him one of the most successful investors of our time. Thank you for watching this video. If you found it valuable, please consider subscribing to our channel and leaving a like. Your support helps us continue producing quality content. So keep watching our channel for more insightful business and investing tips. Until next time, remember, the best time to plant was 20 years ago. The second best time is now. Happy investing and good luck.